Hi, I'm Roger Aguinaldo, and welcome to the M&A Advisor podcast. Since 1998, the M&A Advisor has been the definitive source dedicated to recognizing achievement, delivering unrivaled thought leadership, and connecting the world's mergers and acquisitions elite. We help you sharpen your edge and accelerate your success in deal making. Whether you're an ambitious new player or a market veteran, this podcast provides masterclass strategies, unvarnished stories, and vital lessons from the industry's influential figures. Before we launch into this episode, be sure to follow us on YouTube, Apple Podcasts, and Spotify, and subscribe to our essential M&A Alerts email newsletter. Find all the links below. Your engagement fuels the deal-making community. Now let's get into the transaction.
Good afternoon, everyone. Thanks for having us today. I was going to have a chat here with Adam just to talk about what the M&A activity has looked like in 2025, where we're going in 2026, and then just some of the interesting things we're seeing with Gen AI and how that's impacting what we're doing from a deal flow perspective. Good afternoon, Adam.
Great to see you, Brenda. Thanks for having us here.
Maybe the first question is just to talk about where we've seen deal activity in 2025. There's been a lot of interesting political and economic factors that have impacted deal flow, and maybe a lot of people were a little bullish when we got into 2025 and it was a little slow to get moving. But as we've hit Q3 and some of the more current periods, we've seen some increases in deal activity. Do you think M&A activity is back, and what's your take on what's going on right now?
Yeah, it's a great question. I mean, I do think many of us, myself included, market participants kind of came into 25 very bullish on what was going to happen. There was high expectations, significant tailwinds for the deal markets. And, you know, we saw those kind of evaporate relatively quickly in the first half. And the first half was a very challenging deal market for the reasons you mentioned, Brenda. And so we entered midway through the year kind of wondering, you know, where does this year take us? Summer was okay. We saw actually a slight uptick in our business anyways over the late summer, which gave us a little bit of optimism. And that optimism proved to be pretty true coming into the fall. So post Labor Day, as you'd hope for in a given year, we did see an M&A surge. So, you know, Q3 volume, I just have some stats here. You know, Q3 volume, year to date, October, value was up, 1.6 was up to 1.63 billion, 46% year over year, right? So that's a pretty impressive number. Volume, on the other hand, was only up 2%. So we started to see this deal market emerging where very large deals were getting done, but the overall deal market was still a bit sluggish. This is something that, you know, that we have been thinking a lot about. What does that mean for the future? How do we think about that as it goes forward? I don't know that I personally have the exact answer to that, but it's certainly a dichotomy in what's actually happening in the market. We look at both of those factors from our M&A business. Both are very important. You know, obviously volume speaks to the complexity, size of deals, the amount of money being spent, but volume is how many deals, what is actually transacting. And I think for certain parts of the market, particularly our private equity clients who play maybe more in the middle market where it's not going to drive the value as much, but volume is hugely important as they sit on a lot of portfolio companies that need to get sold. You know, we're waiting to see that volume number start to tick back up, or I should say, hoping to see that volume number tick back up.
Thanks, Adam. I mean, I think as we've looked at some of the deal activity that's happened in the latter half of this year, can you talk a little bit about some of the transaction structures that we're seeing and how maybe some structures are starting to be a little more creative than we're used to?
Yeah, well, I probably don't have to talk about creativity to this room. You are all out there on the front lines actually making this creativity happen. But what we do see when transactions are harder to get done, people start to look at different ways to get those transactions done. So what does that mean? Well, clearly there's been a massive rise in private credit. So people are looking to private credit to finance deals in different ways than they had in the past. That's certainly an emerging trend that we expect to be around, to continue to buoy certain parts of the market for a long time in the future. You also see joint ventures. So maybe you want to get into the business, but you can't quite figure out how to buy the business, or the seller is not willing to part with it. So you come up with a structure that's a joint venture where you can both share in the risks, share in the upsides. So we're seeing some increase in that. The other one is, it's not actually a deal, but it's a strategic alliance. So you're forming an alliance with another partner to get some of the benefits of doing a deal, but obviously not actually, controlling and having those other types of benefits that you would look for. So those types of structures we're seeing more, and we're seeing deal makers be more interested in discussing. I would say, maybe the debt excluded, but joint ventures and alliances can be, extremely complex. You have multiple parties involved. You've seen a lot of successes in these types of deals. They're more prevalent in certain industries, but there's a lot of complexity that goes along with it. I'm sure my lawyer friends here would agree. The more of that complexity that you can get figured out, papered, agreed up front, the better. Because what the last thing you want to do is be in a position where you're disagreeing with your joint venture partner, which has a tremendous amount of opportunity to destroy value in the deal that you've tried to strike.
Adam, we talked a little bit about what's going on in 2025, and while you said we don't have a crystal ball, but wanted to think about what we're anticipating in 2026, and maybe both from a private equity and a corporate perspective.
Yeah, it's a great question, and I often say, I would run a hedge fund if I knew the answer to this question, not work at Deloitte. But what are we seeing, and how do we see it? Maybe just to sort of frame that up first. Obviously, we're on the front lines, myself included, but all of my other partners and managing directors are on the front lines with our clients, talking to them daily and listening to what they're thinking about the deal markets, what types of deals they're looking at, what the deal flow that they're seeing from bankers, what their deal flow on a proprietary basis is. So a lot of information comes to us that way, sort of through those networks. It's not necessarily structured data. It'd be great when we get that all into an LLM, but we don't do that because it's highly proprietary. But it would be great for us to be able to digest that in a way. So we do it, but we do it through conversation with each other, on a no names basis, but trying to figure out what is the pulse of the market. The other thing that we do every time this year is we launch an M&A survey. Part of that survey, it's extensive and it goes into a lot of topics. Part of it is just, how are you feeling about the market? What do you think about volume and value for your specific deal making for the next year? I would say generally, market participants, we're going out to CFOs, we're going out to corporate development, we're going out to private equity firms. So broad spectrum, but they're all sort of deal makers. Deal makers, I think, generally by the field they've gotten into, there's a lot of optimists in that field. People think tend to think things are going to go well. So we often see fairly optimistic. What we saw this year, though, was actually an increase. So we don't just look at raw numbers. We look at sort of what the trend line is. We saw an increase in that optimism. Just to look at the numbers, we had 90% of our PE respondents said that they think 26 will be a better year than 25. 87% of 80% of corporates thought that there would be more number of deals done. And then on value, 87% of PEs thought that the value would be up compared to 81% of corporates. So people are optimistic. That's not necessarily surprising since we have two halves of this year. Sort of, we talked about more recently, things have been brighter, but the first half of the year was a very challenging market. So those those numbers didn't surprise me. What did surprise me a little bit when you got into those numbers was we give people the option of, is it going to be better or much better? The people that said it was going to be much better actually went down. So there is not as much optimism for a significant increase. There's optimism for an increase, but less optimism for a dramatically different market. What does that mean? That's something we're still digging into the data to try to figure out. I think there could be a couple reasons. One is that 25, while challenge, has been a better year than we saw in 24, right? So it has been better. So that could mute a little bit of how fast things people think are going to improve. The other aspect is we did the surveying in Q3, and Q3 was a lot better than we had seen in a while. So people could have had a recency bias in that. So we're not totally sure exactly why that has come down, but it is notable that people aren't expecting a sort of a massive rebound in deal making.
Very interesting statistics in terms of the difference between private equity and corporate. And it seems as though private equity is feeling a bit more bullish maybe than the corporate players. Why do you think that is? What's driving that bullishness?
Well, I think there's a couple things. I mean, if you look at private equity, there's two sides to the coin, right? The one side is they've raised a lot of capital. There's a lot of pressure to put that capital to work. LPs don't want you sitting on the capital that they've given you to invest. They want it to be put to work. So that part creates emphasis to do deals. And then the flip side is a lot of firms were bought by private equity over the last several years. Not so much in the last 2 years, but prior to that, during the pandemic, near post-pandemic period, tremendous amount of firms went private into private equity hands. That puts a lot of pressure as you think about the length of funds. There's a lot of pressure to do something with those companies. They have to transact at in some way, whether that's combining it with a different company, whether it's completely selling it off, whether it's putting it into a continuation fund, or whether it's taking it public. There's pressure, and I sort of talk about, it's a little bit of a coiled spring. At some point, it's going to have to hit the market. So some of it may be just realizing that, the longer that we go into a sort of lower deal transaction market, the emphasis on selling those companies becomes higher and higher.
We've been talking a lot about corporate private equity and just where the market is headed. But from a sector perspective, what is your thoughts or insights in terms of what sectors do you think are going to be strong as we move into 2026 from an M&A activity perspective?
Yeah, sectors has been a really interesting story this year in the sense of, tariffs have had different impacts on different sectors. That's not news to anybody here. But if you're looking at a very high international dependent supply chain, those deals have typically been very hard to do because you don't really know where tariffs are going to end up and what's going to happen with those businesses. So you've seen those types of deals struggle to get done for those reasons. Macroeconomic environment hasn't helped as well. There's been mixed messages in the macroeconomic environment. I think put the other side is we've got interest rate reductions. We've moved a half point down. So I think those that will help all industries. I mean, overall, we saw relatively flat industries over the year, but with a couple of exceptions where you saw U.S. domestic type businesses. So obviously we saw very large primarily U.S. based transportation deal get done. You've seen more activity in software where potentially tariffs so far haven't had as major an impact. You've seen certain FSI deals, consolidation in banking has started to happen, and it appears to be a continuing trend. So certain things there. I would say, again, I expect until we get more clarity on where things are going to head with tariffs, which hopefully, I mean, I'm guessing we all kind of hope that we will get more clarity and we'll start to see where things are going to land. I actually think that could be a real tailwind for deals. I think I'm no expert on policy, and I'm not going to pretend to be one, but there's likely to be certain tariffs remain in place. That could spur people to decide, hey, I want to invest in certain areas because I want to diversify my supply chain, or I want I want my supply chain to be instead of in this country, in that country. And so maybe there'll be trading of assets, or could be building of assets, but it could certainly lead to M&A, where people are looking to have changes in their supply chain that they can take advantage of in a new and different economic trade policy environment.
Big topic on everybody's mind today is Gen AI. So when we think about Gen AI and how it's transforming how we deliver M&A transactions, what do you think the biggest opportunities are for people thinking about how to use Gen AI today in the deal market?
Yeah, well, maybe I'll start with us internally, because very close to our efforts. Obviously, Deloitte, we have a big M&A practice. We're obviously a very large technology business as well, and technology consulting. And so we spend a tremendous amount of time focused on technology, how it's impacting the world, and what's going to happen. And so we're fortunate in our M&A practice to be able to leverage that thinking. We spend a lot of time thinking about what tools we can use. Some we'll develop internally, some we'll partner as well. We're not naive to think that we're going to be the only game in town as far as developing the best tools. So we are looking at partnering with different groups with expertise that we can leverage. So we spend a ton of time. One of the biggest things that I focus on as a non-technology, I spent my career helping buy technology companies, but I would not call myself, don't put me in front of a coding station and ask me to build something. That's not going to get you very far. But we spend a lot of time teaching our people about how to leverage these tools, because I think the tools will continue to advance, and my biggest personal risk is that our teams don't advance fast enough to take advantage. So that's kind of how we use it. What am I seeing out there in the deal market? I think there's a couple of things, right? So I think we are starting to see teams use AI in their deal-making process. I'd say typically, one of the biggest uses is like target screening. You got a ton of data out there. There's a massive amount of data. That's what AI can be great at. It can be great at taking that data, synthesizing it, and making that target screening approach that used to be, pretty highly manual, making it a lot more efficient, so you can narrow down your target. So that's one aspect. And there's other parts of the deal cycle we're seeing it used in. To some extent, diligence, reading contracts. It can be very good at reading contracts and things like that. And so there are definitely uses in deal making that are making it faster and better. The other areas that we see, I would say, people are acquiring AI, whether that's the tech or the talent. I think seeing a lot of talent. People are worried that they're behind, and one of the best ways to catch up is M&A, right? So going out and acquiring tech and talent to fortify your own M&A capabilities or AI capabilities to really accelerate that is something that we're seeing a lot of deals happening. Now, some of those are relatively small, simple deals because it's, a few people in a garage type thing. But some of them are bigger. And I think we'll continue to see a trend of bigger companies that are a little bit more developed. These companies are developing incredibly fast. And so you're going from 0 to 100 million in ARR, in less than a year at times. It's quite wild. So we'll see bigger deals, I think, getting done for those reasons. And lastly, where we're seeing sort of on the cutting edge, I would say, is people looking at how AI, so there's a diligence aspect of how AI is going to transform the market your company is selling into, the target is selling into. What is going to change? What do you need to be mindful of when you're buying that company, and how to think about that? So that's really important. The other part is synergies. What can you take out of this business by leveraging AI that maybe they haven't thought about and maybe the other buyers haven't thought about? If you can do that more effectively, you get the chance to, hopefully, buy it at a bargain, or maybe more likely be able to transact that business at a price you feel more comfortable with that is the winning bid. So those are the main things that we're seeing in AI.
Okay. I mean, I think our time is about up here, but I mean, I think it'll be interesting a year from now if we're all sitting here just to see how far Gen AI has come. It's moving at such a very fast pace. So it may be interesting just to see how we have adopted both from a talent and then just how we do transform transactions.
Yeah, I think it's, there was times sort of 18 months, 2 years ago where 30% of us wouldn't have been in this room and we were all going to be replaced. That hasn't happened. I tend to be an optimist, and I believe what AI is going to do for us is transformative. I think it will change everything that we do, but I don't think the talent that sits in this room is going anywhere. I think it's going to make us, better, faster, stronger at what we do. And so, that's kind of my view on how things will transform. Again, the crystal ball is a little cloudy today, so can't say for sure.
Well, thank you everyone for the time today. We really appreciate and enjoyed being here.
Thanks, Brenda.
We hope today's episode delivered actionable intelligence. We want to hear from the field. Share your questions or insights, leave a message on your favorite platform, or email us at editor@maadvisor.com. To secure your steady feed of premium M&A content, follow us on Spotify, Apple Podcasts, and YouTube, and subscribe to our M&A Alerts email newsletter. Find the links in the description below or visit us directly at our website at www.maadvisor.com. I'm Roger Aguinaldo, founder and CEO of the M&A Advisor. Thank you for being part of the M&A Advisor community. Until next time, stay decisive, stay connected, and happy dealing.